Futures indicate a higher open on Wall Street. Europe is trading in the green while Asian markets close down on the session. Investment sentiment continues to be driven by events in Europe as the ECB takes further action to shore up Italian bond markets. A slew of economic data is on tap, including imports, trade balance, jobless claims, nat gas inventory, and multiple Fed governors will be making speeches around the country today. I'm Jill Malandrino with The Street, and the morning call starts right now.
Good morning. I'm Scott Redler, Chief Strategic Officer with T3Live.com.
And I'm Jill Malandrino with The Street, and together we bring you the morning call. So yesterday was an extreme day. I don't think anyone expected that. We raced month-to-date gains. So futures are up a little bit on ECB headlines that they're going to come in and support the Italian bond market. So we'll see if the futures actually do hold today, and we see that go through into the entire trading session.
Yeah, yesterday was a very potent down day. It was one of those days to take notice, a day that if you had excessive longs on, clean up shop a little bit. Look at your risk tolerance, look at your commitment to the markets. What type of market participant are you? Are you a momentum trader, a trend trader, or do you have a macro approach? So the trend trader probably got out of most of their longs yesterday, but the macro investor still needs to stay the course because, as we go through some of these charts, as we look at them, I'm seeing small damage, but nothing extreme. Right. So if we take a quick look at the S&P, let me show you what I'm talking about. If you do look from that Tuesday low, that October 4th low, you had a massive move, about 15 to 17% off those lows. Then if you remember a week or so ago, you had these two distribution days, which put us back on our toes somewhat, and it took 7 days to get that back. And then yesterday, pow, wiped out all these days. And typically, a big day like this, which we haven't seen during the course of this entire rally, has to be noticed. So at this point, we need to see what it leads to. And at this point, I think the futures are up 10, 12 handles. I think if we can close back above maybe 1250 to 1255 on the S&P, it'll relieve some of the short-term pressure. But I think the next day or so is going to be very important to the intermediate action moving forward.
Right, and just like every Thursday, it tends to be, whether it's in earnings or whether it's economic data, there's a ton that the market has to digest. In fact, today we're looking at jobless claims, imports, trade balance. We have 3 or 4 different Fed governors making speeches around the country. So let's move into the sectors and take a look at the sectors that have been performing the best. We'll look at the ETFs, the Qs, the RTHs. Financials, even they were looking pretty good last week.
Yeah, so we want to see, during a move like yesterday, which sectors held up best in order to know where to go once we get our footing. And the RTHs, which is the retail sector, has been acting the best and is still above its 21-day, and there are still stocks that are in their upper ends of the range, almost ready for momentum.
Right, and also they're rounding out earnings this week as well.
Yes, so if you look at the chart of the RTH, you will see, here you go. We all thought perhaps on Tuesday the market was ready to rumble. It was going to take out this pivot high, take out the old highs, and then obviously yesterday happened, which was a short-term negative. But if you look here, we're above the 21-day, and we're well above the 50-day, and we're even just even above what could have been big support. So it never even got down here. So stocks in this sector or in this group definitely are more investment quality than some of the other sectors.
Right, even the Qs, they were down 3.3% yesterday as well, and that's been performing up until yesterday. The charts almost look identical to the SPX and to the RTH.
So if you look here at the Qs, you'll see exactly what Jill's talking about. You're seeing that, granted, we're not ready to make new highs like it looked like we were on Tuesday, but yesterday's day just kind of kept everyone a little bit on their toes, got some people out of some positions, but we're above major support. We're above the 50-day moving average, so it's not game over yet. It's just, take a step on the side and just realize that you need some hedges and that there's still a lot of headline risk in Europe and everywhere. So, yesterday's day is one of those days, again, to take notice. But if it can get back above this 57, 22 in the Qs, it would negate some of yesterday's negativity.
Right, and moving along to the OIH, the underlying commodity has been performing really well over the past couple of weeks, but this one, it took a hit, 5.6% down yesterday.
Yeah, and it's come a long way, so we want to see whether or not this is a new direction change or just, it has to absorb it. And oil has been unbelievably strong. Not sure exactly why, but when you don't know why, you just let it be. So if you look here at the OAHs, you will see that, this group has been, acting very well off the lows. You do have a short-term range resolution as it broke this mini uptrend, but again, above the moving averages, above key support. All it means is that it's not going to be breaking out to the upside anytime soon, and just be a bit careful that you could see 121 or 122 on it. So if you're not committed to it, make sure that you have your line in the sand right there.
Right, and yesterday, my biggest concern overall is that the financials and the industrials led the market down, and those are always leading indicators. We always go to big names, the transports, the big banks to find significant support into the market. That's always a confirmation for us on the fundamental side, at least. So let's take a look at the XLF. It was our options profits play last week, and even with that, we ended up doing a calendar spread with December and February because we still don't see that confidence yet this year. What are the charts telling us?
Well, the charts look different than what we just saw in retail and tech. This actually resolved to the downside. And it was trying to hold in there. Like we were seeing some decent trades in a lot of the financials. And yesterday, we saw a lot of negativity, a lot of chart breaks. So if you look here at the XLF, you will see that this ETF resolved this big macro wedge, even further to the downside. It's still above the moving average, and it's still above, bigger support. So it's not something to get so worried about. But you want to see what this leads to. And for momentum guys, this is a clue to get out of the way. And, we'll see how it handles yesterday's low. Again, if this could just take back 1310, it'll negate some of yesterday's importance. But that's the same thing, I think, with any of these market indices right now. What you want to do is you want to see how much yesterday, how much of their importance there is. And the way you measure that is, do we take back a third of yesterday? Do we take back half of yesterday? Or more? Anything more than half, yesterday means relatively nothing, but if we were controlled by it and we only get to take back a third, then you know that yesterday's weakness could lead to a lot more. Right,
and rounding out the sectors, the XLI, which is the industrial ETF, this thing was down almost 4%. Again, is it really something to get concerned about, or is it just a function of the market overall?
That seems to be the theme right here. And if you look, you will see that it did break this little 4-day streak, and this day was a bit wider and more extreme than the last 4, so that always gives you the short-term direction. But again, above support, I would watch this area, which is about 32 on the support side, to see if this continues to the downside.
Right. So yesterday was ugly, but if we look at all the charts, the SPX, the Qs, all the major industries, we see that they're kind of all trading in tandem. It's not like it was anything specific or fundamental. It was just a function of the market being really ugly.
Yeah, and bond yields in Italy above 7 and just the extreme headlines. So when we don't see extreme headlines like we saw yesterday, you get a bounce, but we have to figure out how many of these extreme headlines can the market absorb. And it's doing a good job, but there's only so much you could ignore, so we need to see what happens as we move forward.
Right, and I for one would love to see more rational trading. We are going to jump into a quick commercial, and when we come back, we dive into the trenches.
Hi, I'm Sean Hendelman, CEO of T3Live, where we train, coach, and mentor traders in order to help you put your money to work with confidence. The T3Live approach is a blueprint for you to recognize, adapt, and ultimately take advantage of different market conditions. To begin your training with T3Live, we would like to offer you the opportunity to enroll in our free 30-day online home study course. Fill in your name and email address, and I'll see you on the other side.
Welcome back to the morning call. We're going to jump into the trenches, following along like the sector theme, looking at names following earnings that had some momentum. And it wouldn't be the morning call unless we spoke about Apple. And I know this has been really frustrating for you guys to trade.
Yeah, because it's been trapped in this box. And we're trying to use Apple as a barometer for the market. And over the course of the last 3 weeks, it's been lagging the market, trying to figure out what it really means. Does it mean that it's just really absorbing the passing away of Steve Jobs, or perhaps a little fumble on the iPhone 4S launch? Or does it mean that lower prices are to come? So if you look at the chart here, you'll see that this is what traders are really frustrated with, because when Apple has no momentum and it's caught in this area, it gets frustrating because everyone trades for it or looks for it to break to the upside, and that hasn't happened, or to the downside. So at this particular point, it's at the bottom end of the range. It actually closed right around the 50-day moving average, and today I think it's opening like $3. So it's opening right around this $3.99. For the bullish case, I think they want to see it close back above 400 and get out of harm's way. But for the bearish case, and I know there are a lot of traders looking for some momentum, they want to see Apple go from up 3 to negative, trade through that moving average, add to it on the short side, and then perhaps get a move to the 100-day, which is around 381, or maybe even the 200-day. And I think we're going to look at that as a barometer for the market to see which way or which direction takes forward.
Right. Google was an interesting surprise on Tuesday, like around 2:30, 3 o'clock. This thing just shot out of nowhere. Every chat room that I'm involved with, even you guys, are like, what's going on with Google? So how has that played out since that huge move, like around 2:33?
Well, that was actually a great move, and it was somewhat telegraphed because you had good earnings. It was holding higher. You had a resistance area that would squeeze some shorts and get some momentum. So that was actually a trade we loved. It was a nice momentum trade. So yesterday, in the weakness, we were looking to see, can Google hold above that 598 to 602, and it did. So take a quick look here at Google. You will see that stock still looks okay. This was that great breakout trade above 600. This was on my price point sheet. We were all looking for it. So when it happened, we were actually excited, and a lot of us were in it. and then you had a little bit of follow through, and then yesterday it took it in stride. It closed above, right around that 600, didn't fall apart, didn't come crashing back into this base. So Google right now is showing more leadership than Apple, and something that should be on the radar. I would trade it long versus yesterday's low and see if it could get back above 605 and get away from the 600 zone.
Moving along to another tech bellwether, IBM. This chart's not looking too happy right now, so it looks like it's hitting a funny support line.
Well, we were looking to see if anything can go positive yesterday, and IBM just couldn't. But IBM's near the top end of the range, so in a market that's on a bit of the defensive, you have to give it a bit of a pass. If you look here at the chart, though, you will see on a very, very short-term basis, it's really not upsetting, but this uptrend that I've been drawing, that IBM has been staying above, it resolved below it. So for the first time, IBM broke it. So does that mean game over? It just means no, just a little bit of a different pattern. So if you're long IBM, it's okay. If you're not really committed and it starts to break below yesterday's low of, just say this 181, you could see 177 pretty quick. So at this point, I don't see a momentum trade happening anytime soon above this area. At this point, it's a bit on the defensive. Traded versus yesterday's low. If it breaks yesterday's low, the moving average there is around 177.
Right, and we played this name multiple times with you and also with options profits. And if you look at the chart over the summer, it looks fantastic. It was clearly an outperformer in a tricky market. So we always go, we go to names like that for guidance. So curious to see how this one plays out, because it's a play near and dear to my heart. And moving along to another one, our first options profits play that we did with you, LVS.
Yes, LVS has been in this 9-month base. Every time it looks like it's going to break above 49 to 49.50, it always fails. I was long going into yesterday. Yesterday was a down day, but again, it took it in stride. The more I look at these macro patterns, the more I see that they're still intact. On a micro basis, a little upsetting because momentum might not be there as quick as I would like it, but on a macro, it's still fine. If you look here at LVS, you will see that you have this little upper area that just kind of got resolved to the downside. But if you look a little bit longer term, this uptrend that started back in October, we're not even testing that line yet. We're not even testing 45 yet. And then if you take even a more macro look at it and look at the size of this overall channel, it's still at the very upper end. So with Italian bonds soaring and the headlines out of Europe making everyone really worried or upset, LVS is still hanging around near these highs, so it's still investment quality.
Rounding out with Lulu, again, one of these names like a Starbucks, $5 cup of coffee. Everyone's complaining about the economy, but they're still buying $5 cups of coffee. Same thing with Lulu, $100 pair of yoga pants. How did this name hold up in yesterday's market?
Well, girls look good in Lululemon.
There you go.
There you go. So people want to look good, and so if you're feeling bad about yourself, at least you want to look good. But the stock yesterday held in pretty well. On Tuesday, it tried to break above the descending channel, so it was one of those candidates yesterday to go green, and it did act somewhat well. So if you look here on Lulu, you will see the chart. Overall, look at the macro picture. It's still at the upper end. It's still wedging. You take a closer look here, you will see that it tried to get going on Tuesday, and then this was yesterday. And look at this. This is all yesterday was. No real big deal. So if yesterday does lead to more downside, you could see 52, and then the moving average here is at 49.35. But if we go up today and it holds, this rally or this market stock still looks good.
Okay, we're going to jump in. We're actually move along to quick hits for some quick cash, but stay tuned for the options profits call, because we're going to look at Lockheed Martin, which is a little bit of a different name for us to play. It's a defensive name. Going into quick hits, let's talk about Amazon. No one has loved this name over the past 2 weeks, especially since it disappointed after earnings. Yeah,
investors are definitely in the penalty box with Amazon. It hasn't even come close to filling the majority of its gap. There was a little bit of a trade there for momentum, a few weeks back, but if you take a quick look here, it's really on my B list. I don't really talk about it that much. It actually just broke below this minor support. This has been holding for the past week or so. So when it broke below 213, it now could get more pressure. So traders are probably going to be looking with this up open to short Amazon. If it goes negative and trades through yesterday's low of like 210, you could see it move back down to this lower area. So I would just avoid it from the long side, but traders might look for this as a short.
Okay, moving along to my favorite sector, the ags. Let's look at CF, which has been an outperformer.
Yeah, yesterday, a little discerning. That pattern got a little bit more beat up than some of the others. So if you look here on CF, you'll see that actually not too bad. This was that upper flag. We were hoping to get a momentum move to the highs, but yesterday took that off the table. Not so bad, but this makes it look a little bit like short term. It wants to see about 159, and if that doesn't hold, it could go all the way back to 148. But if the stock is strong, I think it doesn't break 159.
Okay, and Goldman Sachs, the stock everybody loves to hate.
Well, a lot of guys made money short there yesterday because we were watching that 102. I was been talking about Goldman Sachs and the banks saying as long as Goldman hangs out above 102, 103, the banks can continue just to be in groove with the market versus a headwind for the market. And yesterday, if you look at this chart, you'll see that it got very negative on Goldman. Goldman better bounce today, otherwise it could be in trouble. Look at this uptrend that Goldman's been riding since early October that really resolved. Like, this is different than some of the other charts we just saw. Resolved to the downside. And at this point, you could see a move back down to 95. If you want to be long, trade it versus yesterday's low. But I have a feeling that traders are going to see this up today, and they're going to try and short it, and they're going to add, if it does break yesterday's low, of about, 98.50 or so.
Well, I mean, that could be an interesting play because there's some negative headlines coming out of the New York Post around mortgage-backed security. So fundamentally and technically, you might have a good short there. Let's move to FCX, which is a relative underperformer, even in a horrible market yesterday.
Well, FCX, I haven't heard any of my traders really talk about since the October lows. It was a decent bounce candidate, but as of right now, that's all it's been. Not a leader, so if you take a quick look at FCX, let's see what it's doing. FCX, nice move from the lows, and it's been very, very choppy since. At this point, I don't think it's an investment quality. I think it's just a trader, and right now, if it breaks below yesterday's low, you're going to see a move back down to this 37 area. So I think this is something that traders are going to be looking to short today to see if you get any continuation.
Okay, and rounding it off with the VXX. Now this is interesting. It's not your typical ETF, it's actually an ETN. And it also trades on the future, so the term structure is different. I always recommend, and we talk about this on OP all the time, make sure you understand how this thing trades and how the term structure works if you want to be successful with this product.
Well, the VIX, it spiked up huge yesterday, and it's probably down with the futures up. So it's something to watch. If you take a quick look here, a lot of my guys like to trade it and use it as a barometer. And yesterday, the VIX broke out again, showing some fear back in the market. And ever since the October low, this has been coming in. And yesterday, you had obviously inverse to the market here. It had a nice spike. So the question is, if the market starts to go negative, you want to buy the VIX because then obviously volatility should shoot up. And I always say that if you're going to be long the market and you're going to have 8 to 12 positions and you're staying committed, what helped me on that yesterday's big down days, I was short some spiders. A lot of time, like if you want to have a hedge, if you're holding a lot of positions, be long the VIX. So if you do get days like yesterday, you're making money somewhere as you're watching your stocks pull in where you could potentially add to them. So use that as a hedge or as a trading vehicle.
Right. When we also, and to round it out, we've played in SDS before, which is the triple short of the market. So that's another way that you can hedge if you have multiple long positions. So we're starting to take a look at more of those. That said, we have a very, very busy day ahead of us. We have a lot of headline risk. There's just so much happening in Europe. How are you managing the psychology? How are you managing your positions? How do you trade intraday where, your stops are just getting blown out?
Well, you just have to know your levels ahead of time. So a lot of my guys have a plan in front of them. We have a price point sheet which has about 30 stocks that gives you support, bigger support, resistance, action areas. So when the market's moving fast, you actually know where to look down and say, oh, Goldman's breaking 102, what's the next support? Okay, 98. Or Apple just broke 98, what's the 50-day moving average? It's all on the sheet, Right. So you're moving quick, but you know where to look instead of like trying to look at the charts, trying to go through your notebook. So when in a fast-moving market, you need to be that much more prepared, and you also have to know your risk. Like yesterday, I knew, we're opening down 250, but we could easily be down 400. So do I want to just hold my nose and go underwater or trade out of my positions, get a little flexible, and then refigure out how I could put back some things on if the market proves that yesterday wasn't as dangerous as it was perceived. So really it's being more prepared, more ready, more psychologically ready, and just understand your whole skill set too, so you have conviction when your patterns trigger, so you're not second guessing yourself and you can move fast.
Right, well that's 80 to 90% of the game plan is having a defined trading plan. Everyone have a great week, good luck, pay attention, be nimble. I'm Jill Malandrino, that's your morning call.